Differences between stocks and bonds. Stocks and bonds, both of them, are considered as a means of finance for a corporation. A corporation may issue stocks or issue bonds in order to collect money, to get a source of finance. In case of stocks, the money collected is considered as part of the capital, while in case of bonds, the money collected is considered a liability. We call it bonds payable. It's like accounts payable. It has to be repaid back after a specific period of time. But in case of stocks, as being part of capital, the money collected is never repaid back. It remains within the corporation throughout its whole life, unless in case of liquidation only. If the corporation is being liquidated, in this case, the assets will be sold out and the capital will be repaid back. But for bonds, it has a maturity date. What's maturity date? It's a specific date in which the value of the bond will be repaid back to bondholders. Those from which the money from which the corporation collect money as liability from issuance of bonds, those are called bondholders. Bondholders are lenders. They do not have voting right. They are not owners. But in case of stocks, stockholders are owners and they have voting right. Stocks has no maturity date. There is no specific date in which the value of the stocks will be repaid back to stockholders. But in case of bonds as a liability, the principal value of the bonds will be repaid back to bondholders on maturity date. Bondholders are lenders. They do not have voting right. Stockholders are owners of the company. They have a voting right. Stockholders get part of the profit of the company. After the declaration by the board of directors, the stockholders get dividends, which is part of the profit of the company. What if the corporation is not realizing profit? What if the corporation realized a loss, or the board of directors for any reason did not declare any distribution of dividends to shareholders? In this case, the stockholders will not receive any part of profit and will not receive the dividends. But in case of bonds, bondholders are promised a specific fixed interest rate on the value of the bonds, which must be paid on time. Whether the company is realizing profit or loss, this interest rate must be paid. Dividends paid to stockholders are not deductible from taxable income. The dividends paid to shareholders are not recorded in the income statement as expenses. No, they are distribution of profits. After the corporation realizes the profit and pays the tax on this profit, then the net profit will be put in the retained earnings as we studied before, and then the board of directors would decide to distribute dividends to shareholders or not. Dividends will be distributed from retained earnings, and they are not considered as expenses, so they are not deducted from the taxable income. Interest payments to bondholders are deductible from taxable income. Interest paid to bondholders is considered as interest expense to be deducted in the income statement as an expense before reaching the net income. Another difference between stocks and bonds is that the company may issue stocks at par value or at premium, more than the par value. The stocks can be issued at par value or at a price more than the par value. We call it a premium, and you know the difference will be additional paid in capital. In case of bonds, the bonds may be issued at par value or more than the par value at premium or even at discount, which is not for stocks. Here we are having a difference that the bonds can be issued at par value, at premium, or at discount, while stocks can only be issued at par value or at premium. Another very important difference is in case of liquidation, stockholders obtain the par value of their stocks from the amount remaining after paying the bond principal and interest in full, which means that bondholders must get all their rights first before any money to be distributed to stockholders in case of liquidation. If the corporation is going out of business, it will be liquidated, the assets will be sold out, and the first thing to do after selling the assets is to repay the liabilities. So the bondholders, as they are lenders, the money owed to bondholders is considered a liability. All the amount of bonds and the interest to be paid for the bondholders must be paid first before any money is distributed to shareholders in case of liquidation. So we say that bondholders are having priority in the distribution of assets in case of liquidation. Here we have a solved example for the issuance of bonds at par value. We said that bonds may be issued at par value, at premium, or at a discount. And we are going to study these three different cases. For the first case, this solved example is about issuance of bonds at par value. It says assume that on January 1, 2000, a corporation issues 10,000 bonds of 12%. It means that the number of issued bonds 10,000 and it's a 12% bond. It means that interest will be paid as 12% annually. And the bond matures in 20 years. We said that bonds are having a maturity date on which we have to repay the liability. So these bonds matures after 20 years. Interest on the bonds are payable annually. Sometimes interest may be payable semi-annually. But in this example, it's paid annually. At the end of every year, the corporation will have to pay the interest on the bonds, which is 12%. If all the bonds are sold at par value or face amount, which is 100 LE per bond, the face value of the bond, the par value of the bond is 100 LE. And in this example, it says that the bonds were issued at par value, not more and not less. How many bonds were issued? 10,000. How much money was collected? You multiply 10,000 by the price 100, so it's debit cash by 1 million. That's the money collected from bondholders. This money collected is considered a liability, so it's the credit bonds payable. The same as you used to journalize when we used to say that a company got a loan from bank. You used to debit cash and credit loan. Debit the cash collected and credit the liability. So here cash was collected from issuance of bonds. So the debit is cash and the credit the liability. We call it bonds payable. The number of bonds 10,000 multiplied by the par value of the bond 100, so it's 1 million. On December 31, at the end of the year, the corporation will have to pay interest. How to calculate the interest? The value of the bonds 1 million multiplied by 12%, 1 million times 12 over 100, we get 120,000 as interest expense to be paid every year for bondholders. So you debit the bond interest expense, like any expense, it's debit, and because we paid cash, so cash is credit by 120,000. And this journal entry will be repeated 20 times because it says that the bond's life is 20 years. So every year during the 20 years, the corporation will have to pay interest expense of 120,000. On maturity, it's very simple. You just close the liability by paying back the par value of the bond. So it's debit bonds payable to close the liability, credit cash because the corporation will pay the cash on that date. Issuance of bonds at premium means the bonds are issued at a price higher than the par value. If the corporation is paying a high interest rate, so there will be demand on buying the bonds. When the demand on buying the bonds is high, the price of the bond would increase. So the bonds will be selling at a high price. The corporation will be making profit from selling the bonds at a price higher than the par value, and this profit comes from having to pay higher interest rate. In the example that we have here, it says the corporation issues 10,000 bonds. The interest rate is 20%. And it's also a 20-year bond, so maturity date is after 20 years. Interest is payable annually. The corporation would have to pay the 20% at the end of every year, each December 31. And the bonds are sold at a price of 120 per bond, while the par value is 100. So we can see that the par value of the bond is 100. The value written on the bond is 100, but it was issued at a price higher than the par value. It was issued at a price of 120. The first journal entry is to record the issuance of the bond. It would be debit cash collected. You calculate the cash by multiplying the number of bonds by the price. The bonds 10,000 multiplied by price 120, you get 1,200,000. The bonds payable, the liability, will be according to the par value, not the issuing price. The par value is 100. To calculate the bonds payable liability, you multiply the 10,000 bonds by the par value 100. You get 1 million. And the difference between the cash collected and the amount of payable as bond payable is called bond premium. It's 200,000. At the end of the year, the corporation would have to pay the interest. To calculate the interest, you multiply 20% by the principal value of the bond, by the 1 million, the par value of the bond. The interest is paid on the par value of the bond, not on the price. You multiply 1 million, which is bonds payable, by 20 over 100, you get 120,000 as bond interest expense. It's debit expense, credit cash. And this journal entry will be prepared 20 times according to the number of years to maturity. But at the end of the year, we close the bond premium in the bond interest expense, and we call it amortization of bond premium. Amortization of bond premium means that this bond premium will not be considered as a profit for 1 year, because this profit was realized once when the bonds were issued for the first time. But the bond's life is not 1 year. The bond's life 20 years. So we need to divide this bond premium on the whole life of the bond to be used up every year part of it. We call this amortization. So the bond premium, which was 200,000, will be divided by the number of years to maturity, which is 20 years. So every year we use 10,000 from this profit to be considered as reduction in the expense, because the interest expense was high enough to get the bond premium. The interest expense was the reason why the corporation first of all sold the bonds at a profit. So what caused the bond premium? The higher interest expense the corporation is paying. So at the end of the year, the corporation would adjust the interest expense by the amount of profit that belongs to this year. You just prepare a journal entry for amortization, debit bonds premium, and credit bond interest expense. By this journal entry, you take from the bond premium and you take from the interest expense. On date of maturity, the corporation would pay the payable. So it's debit bonds payable and credit cash. Issuance of bonds at discount. It means the bonds will be issued at a price less than the par value, which is the opposite of the previous case, where bonds were issued at premium. In this example, the bonds are issued at discount, which means the bonds will be issued at a price less than the par value. And this may be caused because paying a lower interest rate. So the demand on the bonds are not so well. When the demand is not good, the price goes down. So the price of the bonds in this case was lower than the par value because of having a lower interest rate on the bond. It says the corporation issues 10,000 bonds and the interest rate is 10%. It's 20 years bonds, and the price at which the bonds were issued was 80 per bond, while the par value was 100. The first journal entry on the issuance of bonds, it's debit cash because cash is collected according to the issuing price. 80 times 10,000, you get 800,000. That's debit cash, cash collected from the issuance of the bond. In the credit side, you can see bonds payable, which is the liability, calculated according to the par value of the bond. So it's 10,000 multiplied by 100, you get 1 million. The difference between the cash collected and the bond payable will be called bond discount. It's debit. It's considered a loss. The collected cash was less than the liability of bond payable. At the end of the year, the corporation will have to pay the 10% interest calculated from the bonds payable. So the bonds payable 1 million multiplied by 10%, the interest to be paid will be 100,000. Debit bond interest expense, credit cash. Interest expense, like all other expenses, debit, and as it's paid cash, so cash is credit. Then the same logic as we said before for the bond premium, but in its opposite case. In case of bond discount, it's a loss. It was realized at the very beginning of issuance of bonds, but it doesn't belong to only 1 year. It belongs to all the 20 coming years, which is the life of the bond. So we need to amortize the bond discount over the 20 years life of the bond. To amortize the bond discount, it means you divide the value of the bond discount by the number of years. The value of the bond discount 200,000 divided by 20, so every year 10,000. This 10,000 will be added up to the interest expense because the interest expense paid was very low, which caused the bond discount to happen. So we rise the bond interest expense by the amount of bond discount every year, and we call it amortization. You just get the value of the bond discount divided by the life of the bond, and you prepare the amortization by closing the bond discount in the interest expense. Debit bond interest expense, credit bond discount, and both the journal entry of payment of interest and the journal entry of amortization for the bond discount will be repeated every year throughout the whole life of the bonds for 20 years. And then the last journal entry on maturity date, it's debit, bonds payable, credit, cash. As we said before, you just close the liability and pay the liability cash.